Hello, everybody. Welcome to my solution walkthrough for problem 16-3. This is the Intermediate Accounting 17th edition textbook. Authors are Don Kiso, Jerry Weingant, and Terry Warfield. The question used in the presentation is copyright 2019 by John Wiley and Sons. Wiley, all rights are reserved for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. The solution presentation is copyright 2019 to 2022 by Bennett Tchaikovsky. All rights are reserved. The opinions contained within this presentation are those of Bennett Tchaikovsky and not the authors of the textbook or of Wiley. Okay, so let's take a look at problem 16-3. So again, if you would like access to where I got these questions from, if you go to zlibrary.org, you'll find this as well as many other textbooks for free download. Okay, so right over here, stock option plan. So we adopted a stock option plan on November 30th that provided 70,000 shares of $5 par value stock to be designated as available for the granting of options to the officers of the corporation at a price of $9 per share. The market price per share was $12 on November 30th, 2020. So I'm going to say this, you would never do it this way in real life. And it's because when you're issuing shares below market, it causes a lot of problems. So before you do stock options for your company, really make sure that you're talking to corporate counsel. Make sure you have your securities counsel there to make sure you're following all the applicable securities laws. If you're issuing below market options, that can really cause a problem and a big headache. So typically what you would do is when you make the grant, it should be the closing price of the stock on that day or whatever the terms of the plan are. Probably should be done after market. But again, you have to follow some really strict procedures because you do not ever want to get caught with some sort of like an insider trading, backdating options. It's just an absolute nightmare. So just be really careful about that as you're embarking on your professional careers. So enough of the dad advice for the day, or uncle, or whatever you want to call me. So right over here, so January 2nd, options to purchase 28,000 shares were granted to Tom Winter. So shares or options for Winter 2020, Winter 2021. So he was granted 15,000 options for 2020, and he was granted 13,000 options for his services to be in 2021. So this is options right over here. Okay, so for Winter for 2020, how do we go through and value these? Well, it tells us right over here is it says that, oh, actually also on that date, we also have Bennett, cool name, 7,000 in 2020. I actually know Michelle Bennett. She's pretty cool. So Bennett for 2020, and then over here, Bennett for 2021. Okay. So this is also going to be 7,000 options granted. Okay. So right over here, and let's go ahead and do a little separation. Okay. So we've got Winter options for Tom Winter, options for Michelle Bennett. Okay. So the market price of the stock was 14 on January 2nd. The options are exercisable for a period of 1 year following the year in which the services are rendered. The fair value of the options on the date of grant date was $4 per option. So they're getting these options. So basically the fair value on the date of grant is $4. So the total amount of stock compensation expense is going to be 15,000 times 4, 7,000 times 4. So my total 2020 stock compensation expense is going to be 88,000. For 2021, it's going to be 52,28. And so here for 2021, it's going to be 80,000. Okay. So right over here, what we're going to go ahead and do is we'll go ahead and fix this real quick. Perfect. All right. So the way I'm going to go ahead and record So that's basically what's been issued. Okay, so in 2021, neither the president nor the vice president exercise their options because the market price, we don't really care about the market price. Really what we care about is whether or not they're exercised. It's really about the fair value when it's granted. So on December 2022, they exercise their options. Okay, so prepare the necessary journal entries in 2019 when the stock option plan was adopted, 2020 when the options were granted, 2021 when the options lapsed, and in 2022 when the options were exercised. So in 2019, there's going to be no entry. Rather, there's going to be a footnote disclosure. Remember that with stock option plans, you have to get shareholder approval. So the shareholders have to approve of it. If you're a publicly traded company, these are typically registered on a Form S8, which is for employee stock options. So in 2020, we would be debiting stock compensation expense for $88,000, and we would be crediting additional paid-in capital stock options for the same dollar amount. Now, the second thing that's happening over here in 2021 is that in 2021, they declined to exercise their options. So what's going to happen is because they lapse, what is going to happen is when the options on 12/31/21, I'm going to reverse out this entry because we are in their service period. So because to record lapse of stock options, so that's how I'm going to record the lapse of the 2020 stock options. I know many of you, when I look at this, I think it's really bizarre too, but then again, I'm the person who says that that options should not even be, we shouldn't be doing journal entries, we should be doing footnote disclosures. But that would violate SEC law, which I don't want to recommend that you do. It looks funky, but if they're lapsing and it's in their service period, that's what we're going to go through and do. Okay, so for 2021, we have to record the stock compensation expense for the options that they had in 2021. So over here, we're going to debit stock compensation expense again. We'll just go ahead and copy and paste right over here. And this is going to be for $80,000. Okay. Let's record stock compensation expense for 2021. Now in 2022, it tells us that on December 31st, both they decided to exercise their options for 13,000 and 7,000 shares. So the company is now going to be receiving money. So how much money are they going to get? Well, the option price that they had the ability to buy was at, and again, illegal, right over here, $9 per share. You would never set it as a hard value. You would set it at whatever the price of the fair market value price is on that date, or you're going to be triggering some tax consequences. So the amount of cash that we're going to be receiving illegally, I'm just kidding, it's not illegal. Right over here, well, it's just legally problematic. How about that? Over here, this is going to be 20,000 options. So we have Winter, 13,000 plus Bennett, can't say that name enough, 7,000 options. And this is going to be times 9, which is their option price. So right over here, we're getting cash of 20,000 times 9, or this is going to be 180,000. Okay, now, once this happens, right, what we're going to do is we're going to get rid of the stock compensation additional paid-in capital because they're going through and exercising these. And then for the credits, we're going to credit common stock at par. The par value of the common stock is $5 per share, which is still way too high. Should be like 0.0001, but you'll hear me complain about that in other videos. So this is going to be 20,000 times 5, or 20,000 shares times $5 per share. And then over here, to balance myself out, it's whatever I need to do to balance. which over here is going to be 160,000. And to record. Okay, so right over here. So this is where you're going to kind of go through and see it. And as we kind of go back over here and look at this, so we've done the journal entries when it was adopted, when the options were granted, and when the options lapsed, and when the options expired. So it's relatively straightforward. Just again, ignore the market value. But again, I do want to say very clearly that this would cause problems. If I showed this to a securities law attorney and you are issuing below, when you issue the option to the employee, if it is below market, you've got to be extremely careful. So it's going to trigger a lot of problems. So with that all being said, right over here, I want to thank you, Wiley, for allowing me to share this solution with you. Please do not forget to like and subscribe. If you would like to see other solutions, please feel free to ask for them in the comments. Have a great rest of your day, and I look forward to seeing you on the next video. Have a good one.